Very much for that. We have with us Sri Vatsa, Executive Vice President and Fund Manager Equity at UTI AMC, now joining into the discussion. Thank you very much for joining in. Indian markets haven't done too much in the last 12 months. Do you think it's time now for a up move? Are we ready and primed for a recovery? Is it time to allocate cash for a quick, 10% kind of a return?
Yeah, hi. Good morning. Yeah, it's right that the Indian markets have underperformed most of the regional and the global peer markets by a decent margin in the last one year as well as year to date. I think the reasons were a couple of them. I think the most important one was that there has been a fair amount of earnings cut which has happened, and also a slowdown in the earnings which has happened over the last 9 to 12 months, coupled with a higher base valuation last year. Both of them have led to a muted performance in the last one year and a huge underperformance from a global context. However, we feel that the slew of measures by the government, which started off with income tax cut as well as a GST cut and the liquidity boost, will give rise to some decent level of earnings growth. So if you look at the Nifty growth, earnings growth for next year, it's closer to 13 to 14%. We don't expect a big cuts now. So I think all stars are kind of slowly aligning in terms of strong domestic liquidity as well as decent level of earnings growth. And probably the foreigners will also may start look at India favorably in the coming months if they see these kind of positive triggers, because they are also a little bit underowned. The only caution that I would say at this point of time is that the market is still assuming that the US tariff issues will be resolved. I think they are not taking the impact of this 50% tariff. If that were to continue for, say, 6 months, 1 year, that can have some impact on the economy, which is not factored in by the market. So I would closely watch out for that event. If that event is favorable, I would see the markets being very, very favorably poised.
Srivatsa, good morning. Thank you for joining in. On the cusp of yet another earnings season. Do you expect this quarter to be better than what the June quarter was, or do you anticipate a couple of more quarters before the actual reform impact starts to show up in the numbers?
Yeah, I think generally these reforms don't show up in a couple of quarters. There's a lot of supply chain issues. So you would have to wait for at least a couple of quarters before you start seeing the impact. But whatever trends that we are seeing in terms of channel checks, for example, in automobile companies or even in other FMCG companies, are favorably poised. But the final results, say for the September quarter or December quarter, could be slightly different. But as I said, the trend is favorably poised if I look into next year, because if you look at the drags in the last one year, it's been the consumption stocks, automobile, FMCG, which have not grown as expected. If the growth were to return, I think that would set the tone for a very favorable base next year. And more importantly, the quality of growth will improve next year, because this year growth has been led by, say, metals and oil companies, which are more commodity linked. But we need to watch out for at least a couple of quarters before we start seeing the full impact of the GST and the income tax reforms.
I was just seeing your UTI large and mid-cap fund. And that doesn't have any platform companies, which is where we are seeing maximum growth. It's heavily concentrated in financials and IT. So can you tell us why you've excluded some of these platform companies?
Yeah, so in the UTI large and mid cap fund, we clearly follow a very value oriented approach. I would say more of a relative value oriented approach. And the valuation of these platform companies, it doesn't fit into our strategy. So which is why we are more focused on, say, domestic financials, where there is still reasonable value, as well as automobiles. And of course, IT and pharma are kind of contra place, because I think the valuations have bottomed out for both the sectors. But yes, there is a risk of any further escalation of tariffs. But we do believe that the risk reward is quite favorable in these two sectors. So it's a combination of wherever there is growth at a reasonable valuation, as well as where there is an absolute very good valuation for companies which have created good long-term wealth creation.
Does this fit into the criteria? Do PSUs fit into the criteria that you just highlighted, Srivatsa? Of course, it's a very large basket, be it defense, be it railways, be it the oil and gas names, or even PSU banks for that matter. Do your preferences lie anywhere among these PSU names?
Yes, so we are slightly turning more favorable towards PSUs, but they are not a big part of the portfolio. So PSU banks is something that, I'm favorably looking at, because I do believe that they will have a decent earnings growth next year. And the valuations have also corrected meaningfully in the last couple of years. So they are a pure value stocks. We are also favorably looking at some of these PSUs, oil majors, whether it is OMCs or upstream. I think even there, the valuations are quite favorably poised. But defense PSUs is something we don't have in the portfolio. I think we do believe that valuations are a deterrent. But as a PSU, I mean, I don't have a high exposure. But yes, tactically, I think it is looking good from a value perspective.
Thank you very much for joining in, Srivatsa. Get into a break. We'll come back with more on the market. Stay tuned.